Hi, this is CF Lieu from REIT Method Real Estate Investment Trust Method. Now, in this in this episode, I'm going to actually dissect one of the very popular real estate investment trust REITs in Malaysia, which is the IGB REIT. So IGB REIT, as you can see over here in my screen, so I do not really know why the soft copy, the online version of this is actually in black and white, where it's supposed to be, this has some colors to it. But anyway, that's not important. But because in this lesson, maybe 20 minutes or so, I'm going to dissect this IGB REIT, IGB Real Estate Investment Trust Annual Report 2018. So what we are looking over here is what are the important things that I want to demonstrate to you when it comes to this IGB REIT is that you have to look at the structure of IGB REIT, right? So the structure of IGB REIT, you can see the IGB REIT, the major shareholder of the or stakeholder is IGB Berhad, IGB Corp itself, corporation itself. IGB holds slightly more than half of it, so it has a major sponsor than their major shareholder. So you can see over here, if you're not familiar that with this, IGB REIT is basically a real estate investment trust that holds two of their prime jewel properties in Petaling Jaya, KL, Selangor, which is Mid-Value Mega Mall and the Gardens Mall. So for those of you who know Mid-Valley Mall and the Gardens Mall, which is like just next to each other, and you have been spending money there every weekend or every now and then, this lesson will show you how to say that, hey, you're already going to that shopping mall that you probably go to, so why don't you just take this opportunity, learn this lesson, and just make money from the shopping mall, the exact shopping mall or retail mall that you are actually visiting every week or every weekend as well, right? So I want you to for a lot of those public listed company in Kuala Lumpur Stock Exchange, KLSE, that there's a lot of company that you really don't really know what they are doing, and then you just invest into some of this company by hearsay or by whatever method, trading, value investing and all that. But real estate investment trusts, some of them are actually whole public asset that can be accessible to you, and you can actually pay a visit to this so-called Mid-Valley Mall and the Gardens Mall, and easily you can actually have evaluate yourself whether the business is doing good or not, because whatever business is doing good or not in these two shopping malls is going to affect the profit of this IGB REIT, which is if you haven't realized, this is a public listed company or public listed real estate investment trust in Malaysia. So that's how it goes, right? I used to joke with my wife and say that, look, we are actually investing in this, and maybe the more cost hundreds of billions of ringgit and all that, just by for our a minority shareholder like you and me, we probably actually own a few, we probably own one of the toilet inside the mall, or we own a patch of the floor or the tiles on the ground floor or on the third floor or whatever it is, right? So this is something I think real estate investment trust, when it comes to certain REITs, actually this is something you can relate to. Now let's jump right back into this one, just give you a structure of here. Now one thing also to note is that you probably want to actually take note of this what we call as the REIT manager. So the REIT manager actually charges a base fee of up to 1% per annum of the IGB REIT, of the REIT IGB REIT TAV. Now TAV is the what we call the total asset value. In this sense, it's the property value. So if the property value go up, then their percentage stay the same, they will get paid more and more. So you can say that it's kind of like alignment of interest, because they cannot just let the property being devalued by not maintaining it and all that. Every properly maintained property, whether it's whether shopping mall, whether it's commercial property, residential property, you know that if it's properly maintained, then the value will go up. Now over time it's likely to go up, but if you maintain it, then it's likely to go up even faster or even more. So the REIT manager are getting paid by a percentage up to 1% of the mid-valley mega mall and the gardens mall. So this is what it means, right? Actually the base fee and all that is a bit on the high side. Now I mean, it's probably the norm for a lot of retail REIT manager or whatnot. But in some of my other lessons on this or videos on this, which you can watch after this video ends, where I also dissect the annual reports of other Malaysian REITs, real estate investment trusts, and you can see that base fee of 1% of the total asset value is actually on the high side, right? And performance fee also, I know, is on the high side, but maybe that is the norm. You can see that it's 5% per annum of the net property income. So they have a performance fee, so they are motivated to actually generate more net property income or rental income. For the REIT managers motivated to do that, because as the income increases, it's likely that it will your distribution of this dividend or income distribution to our shareholders. If you are investing in IGB REIT, you know that the dividend is given to you, distributed to us based on the number of units or shares that we hold. So the larger is the net profit, the higher the net profit, of course. Over the years, if the net profit keep on an uptrend increasing, so the net rental increases, our dividend per share also increases, which increase the total dividend that we are receiving from this IGB REIT as well. So this is actually this is what we call as alignment of interest between people who actually manage this investment. In this case, it's the real estate investment trust versus the one the investor that invest into it. So just this is acquisition fee at 1% of the transaction value, and divestment fee. Divestment meaning that you are selling the property. The manager also can charge up to 0.5% of the sale transaction, and up to 1.0% of the transaction value when they're actually buying a new property, which I do not expect that they are actually have any plan to buy any, because this two property is good property, already a very big property, and if they want to buy, they are going to probably build another one, or it's really not easy to buy another retail mall that is actually on an equal footing or even better than what they have. We are talking about mid-valley mega mall and also the gardens mall over here. So moving on, I want to jump to here, which I bookmark. As you can see, this is a snapshot, which I think it's sometimes when I actually bookmark certain section of this annual report, means that this is something I find interesting, and this is something, if you are reading the annual report, it gives you a snapshot of what I think are the details of the section you should look at, because you don't need to actually look at the entire annual report, especially when they talk about who are the management profile and all that. You can just skip that through. So as you can see over here, they say that this is the mid-valley mega mall. They have like 99.3% occupancy, whereas for the gardens mall, 97.2% occupancy, which is expected on the high side, which is good for retail mall. And you can see that the parking base are 6,000 and 4,000. I think for those of you who actually frequent this mid-valley mega mall and whatnot on every weekend or so, you know that parking is always very, very hard. You never have to wait, I mean, like a half an hour and things like that. I think even though if they increase it to 10,000 or whatnot, if there is any place, I don't think there is any parking based spaces where they can construct more parking base, right? That is why it's so hard to get parking over here. And you know that this is one of the contributor for their for their rental income as well. Parking is a big, quite huge amount too. So but I just want to show the occupancy for this these two malls, and look at here. Now this is the page whereby it really start to give you a very good perspective of how this IGB REIT is doing. You can see the gross revenue or the gross rental mostly because most of the as you know, most of the their revenue comes from 90% of that comes from rental income. So you can see it's on the uptrend, which is good. Net property income is also on the uptrend, which is good. Distributable income, they mean that dividend that can be distributed back to shareholders. Actually in 2018 it's kind of decreased a bit, which is why you see that here DPU actually decreased a bit over here. Okay, so we want to actually read more on why that is the case. So you can see, you know, distribution per unit DPU actually decreased over here slightly, not to an alarming standpoint, not that I think of. Investment property also, if keep on increasing, the increase is very organic. There's no increase for this, you know, like 2014 to 2016, because they don't acquire new property. So on the asset base, whatever growth or the value of increase they have is basically purely organic as value by independent valuer. So you say the total asset value over here, which actually includes, you know, like their asset, the trade receivable or whatnot, rental that is yet to be received and all that. But I always only want to look at the investment property, because that's the value of the property held under the real estate investment trust or REITs. So you can see it's a bit, you know, NAV performance. Normally you just see that as a reference. Let's just skip to here. And what I think it is important for here to note is that this is where we are actually jumping right into the management report, right? Management discussion analysis. So you want to read and see whether they when there is a decrease, you know, in their net income, the rental income and all that, you always want to check whether they mention anything why that is the case. Now I've highlighted for you over here. They say that for financial year 2018, the group as the REIT actually deliver a steady growth, mainly driven by higher rental income, meaning that they have a rental tenant that is expiring, the lease is expiring, so they are going to renew that. When they renew that, they negotiate a higher rental. That's what it means. So they say posted a gross revenue of 500, more than $500 million, and net property, which we have seen, so 2 to 3% higher compared to the year before. Despite this was higher revenue, higher net property income. Okay, but the NP was okay, representing a decrease compared to with NP in 2017. Why? This was mainly due to the lower fair value gain on investment property in 2018 and a one-time write back of step up interest in financial year 2017. So this is the reason, okay, why we see that why we see this is an indirect reason why we see that there's a decreasing so-called decreasing dividend over here. So you can see that the change was not much in terms of the investment property value. There's a change in cash and balance and all that. Total liability decreased a bit. Cash and bank balance, the variance was due to change in frequency distribution from half yearly to quarterly. So this also tells you that they used to give dividend twice a year. Now they change it to quarterly, like 4 times a year. Okay, and there is a growth, you know, income distribution, NAV, there's a growth of 1 point something percent, not so significant. Mid-valley, so a broader approach to community engagement. So you can see that this is what I think is important. Sometimes it's not about only the figures, it's also about what they are doing, the things that the qualitative side of things, right? So what they have is that they say that they actually took back some space from Aeon, which is, of course, you know, is a supermarket, and normally supermarket occupy the largest space in any shopping mall, right, as a single tenant, because no single tenant normally occupy that space, except I think when you are shopping mall, but when you are grocery store, and you know, when you are cinema, and you know, some things like that. But fashion and accessory on a single tenant basis, normally single tenant don't occupy that much of space. Maybe Sengheng electrical appliances, but what they are telling us over here is that they are actually taking some space from the supermarket and they use it to create 21 additional retail outlets and 4 casual leasing spaces. That has achieved a higher rental income. They say, what is that? There's no spaces being created, but how they achieve higher rental income? Because not every type of tenant in a shopping mall is made the same. So normally you can see that the supermarket, what I've noticed over the years, the supermarket actually occupy the largest space, but on a per square foot basis, the rental is normally not the highest on a per square feet basis. Fashion, accessory, and clothing, garments, that kind of businesses, they occupy a single tenant, one single tenant occupies a lower amount of space, but on a per square feet basis is actually higher. So by actually converting some of those from supermarket, and you convert that into a space that is rented out to tenants who are in a fashion, accessory business and all that, especially lady fashion. So on a per square foot basis is higher, which explains why it says that it achieves higher rental return. Okay, and they say they also reposition the escalator on each side of the mall from lower ground until the first floor, which has allowed for better accessibility for shopper. Maybe that might indirectly contribute to a higher rental income, because you see, just imagine if you feel, you come to a shopping mall and you just feel that the layout is so screwed up, right? For example, what I'm talking about, some shopping mall, you have to normally when you actually travel in an escalator and you want to travel from, let's say, from ground floor to the third floor, you expect that you will be able to just take the escalator from the first floor, and then you just walk a few steps, and then you can just take the escalator from first floor to the second floor. So it's as seamless, as continuous as that, right? That is normal the case. But there's some very screw up retail mall that forces you to actually walk a certain distance before you actually reach another escalator, which for you to go up. So they kind of, I've explained this kind of shopping experience before. They kind of force you to, after you go up escalator one floor, they actually force you to walk past all those retail outlets before you get your chance to actually get on another escalator to go up or go down. Okay, that should not be the case, and I think that is a very stupid idea to actually force shoppers to actually go through that kind of hassle. Let's say if I'm in a hurry, right? You want me to run, like, I travel more unnecessary steps. So what I'm saying, that the direction of the escalator, right, should be very seamless. If this is the way up, then this should be the way up. It would not want to actually go to one floor and then you walk a certain far distance before you can take another escalator to go where you want to go. And that is probably one of the things why they're actually improving the traffic flow as well. So you can see these new tenants are also welcome, including blah blah blah. There's a few tenants over here, you can look for yourself. And then they say on the Gardens Mall, they also increase the retail space. Now this is an increased retail space. Of course, increased retail space, you have more rental income. But when it comes to this, they're actually converting a retail space with a lower per square feet of rental to a higher per square feet rental. So that's the difference, right? And they also add in new store, provide accessibility to the lower ground and the north wing, and escalator, I think, in works to, and they had a work to upgrade Riverside entrance, also complete with 2 bridges that connect the first floor of this of the garden to KL Eco City, Manila South Point ongoing. We are targeting to open this for this year, meaning that at this time of this recording, it should be open already, right? And the risk, okay, in investment, there's also a risk, and as you know that for this REIT, one of the risks that every real estate investment trust will encounter is interest rate risk. But again, that depends on whether they are very heavy on the fixed interest rate or they are very heavy on the floating interest rate. Now, how about for IGB REIT? Now, IGB REIT, according to this annual report, they say that income and cash flow are not affected by the market interest rate, as our borrowings are made of AAA rated medium-term notes. That is a bond, okay, bond on a fixed coupon rate, which is not subject to fluctuation. Okay, so you know that it's a very minimal interest rate when it comes to IGB REIT. Also, every REIT will also have this strict, so-called strict vetting process, whereby as any rental, as any landlord will tell you, there is this thing you need to really take care. when it comes to managing your tenant, because some tenants, you know, the more tenants you have, then, you know, a lot of type of tenants, and then some tenants will actually pay late and default and all that. So that is why they say that to mitigate the exposure to outstanding receivable, meaning the outstanding rental from tenants, you adopt strict tenant selection process to ensure that we only engage with tenants who are of high credit worthiness, so that it's not likely to actually delay the payment or not pay them. So again, not to discriminate against small medium enterprise, but normally these top range mall, they prefer well brand name, like, you know, like those are overseas brand and all that, because less likely to default, rather than if they have one shop, they would rather rent it to a multinational brand or tenant rather than a small brand or tenant or local brand, and, you know, things like that. So this is what it means. So let's see if we miss anything or not over here. Okay, so this is what we have covered this already. And okay, to 5 quarters this year. Okay, Mid Valley, we have covered this, and coming on to next is this. Okay, interest rate, we already covered this. Okay, so let's jump right into the gist of all the figures, facts and figures, right? You know that now, gross rental income. Okay, what happened over here? Gross rental income, as you can see, there is an increase in 2018 compared to 2017. Now, revenue per contact with customer, okay, that's good. Gross revenue 535 versus 524, so there is a increase, which is good. And when you want to see over here, you see that there is a decrease in property operating expenses, which is again very good, because what has decreased the most? Okay, maintenance expenses increase a bit, but there is a decrease in reimbursement costs, and you know, mostly I think it's reimbursement costs, and that's why the net property income is higher. Net investment income is also higher. However, this profit before taxation was kind of lower, which explains why the distribution of dividend are lower. And why is that? Okay, so what happened is there is management fee, which is largely the same, slight increase. Trustee fees the same. Valuation fee, there is a higher valuation fee, and also other what we call there's a finance cost. Okay, I think finance cost is the one that actually you know, like goes up. So what we need to do is look at what is noted by 14, 15, 16 and 17, which exactly what we will be looking at. So you can see that reimbursement cost, this is 14, right? Normally there's a note, so because on the financial statement it will have the figure, but how they come to that figure, you have to jump right below, okay, below, whereby you first see that. So for example, this is actually page 63, right? If you jump below, you go to page 90, they will actually explain more what's this about. So you can see that reimbursement costs, their marketing expenses actually decrease, and admin expenses decrease, management expenses decrease. So they are being very efficient on that. So reimbursement costs decrease, but that's not the main factor. So the other thing is that the base fee and performance fee increase a little bit compared to 2017. It seems reasonable, doesn't really change a lot, because of the property value has appreciated. So their base fee and, you know, performance fee, which is based on the net property income increase, which is explainable, reasonable, and this is also reasonable. So what happened to the finance cost? Okay, so the borrowing cost actually increases over here, as you can see over here, right? 53,000, and so what, let's see if I actually bookmark over here. Nope. Okay, finance cost. So what happened is that why there is a finance cost. Now to actually explain that, we have to jump back right in to one section whereby they say that there actually this financing and all that. So let me actually jump back in, okay, to here. So medium term notes should be over here. Nope. So let's do a search over here, medium term notes. Okay, so guess this is explainable. Medium term notes, right? Now, okay, so you might want to actually look at here and say that why there's a cost increase, because on August 2017 the manager announced the market there's a special purpose vehicle has launched a medium term program of 20 years on amounting to 2 billion, was tenure 7 years, fixed coupon, right. So we fully added of course today we reject coupon based at 5 and 5 and 7 years. So settle this, right? Tenure 7 years, secure third party and all that. So you can read more on this of why there is there's an increase in the cost. I think that kind of explained it. So 4.38% tranche 1. Okay, so trade and other receivable. So this is what one of the reasons that causes it to have a slightly lower dividends over here, which is illustrated by over here. Okay, so to wrap this up, just to wrap this up for your information, whether this is around a recommendation to buy or sell, but any counter or stock, to sum this up, that you want to buy in, of course we are not talking about following blindly, okay, but it helps to know that who are the big stakeholder of this real estate investment trust or any stock for that matter. So you know that the stakeholder was IGB REIT, IGB Bhd, which owns kind of this about half of the holding over here. But more so, you know that REIT management, they themselves also hold a certain percentage, which explains what we have over here, right? And the other thing is that you know that when EPF, our pension fund, one of the biggest pension fund anywhere in the world, and Citigroup is actually nominees and actually holding for EPF, which means that actually EPF is the ultimate beneficiary owner of this stake, and they held a 7.56%. You know that this couldn't be a bad choice for your investment as well, because why EPF actually hold it? Easy. You get dividends, like consistent dividend, as long as IGB REIT is in business, right? Yeah, so that being said, I hope this has been useful, and of how you actually read the annual reports and stuff like that. So for any questions and whatnot, so just comments below. And if you haven't you are seeing this and you are not a REIT Method member yet, do go to reitmethod.com and just sign up for join upcoming webinar I'm conducting over here. We conduct this every week. So that being said, if you haven't subscribed, just click on the subscribe button to subscribe to CF Lieu channel. And with that being said, I'll see you in the next Malaysian Real Estate Investment Trust, Malaysian REIT Dissecting the Annual Report lesson. So this CF Lieu for REIT Method and CF Lieu channel. You have a good day.